Hello, and welcome to my presentation on building a balanced investment portfolio. Today I will be guiding you through an investment strategy tailored to a client who has recently inherited £100,000. This isn't just about picking the right stocks or bonds, it's about building a smart, evidence-based portfolio that considers the client's financial goals, risk appetite, liquidity needs, and tax situation. We also consider modern financial theory like the efficient market hypothesis and back our recommendations with statistical analysis to show how each asset class fits into the bigger picture. Let's dive in. Our client has come into a significant sum of money, £100,000, and is now faced with an important question: how to make this money work intelligently. They're not solely focused on growth. They also want the flexibility to access funds when needed. Liquidity is key, but they don't want that to come at the cost of returns. So the aim is to strike a balance. This balance is between short-term access and long-term wealth creation, between higher yielding assets and lower risk buffers. They ask for clarity on how risky each investment is, how much it could potentially return, and what tax they might face. Our role is to offer professional recommendation that's evidence-based, easy to understand, and aligned with these goals. To give the client a range of options, we've considered 6 core asset classes, each serving a different function in the portfolio. First is cash and equivalents. Low risk and instantly accessible. It's there to cover emergencies and keep the portfolio stable. And second is bonds. These create reliable income with lower volatility. They're great for balancing out riskier holdings. Third up is equities. These drive long-term growth, though they come with short-term risk. ETF, exchange traded funds. These offer broad market exposure at low cost, which helps reduce individual asset risk. And REITs, real estate investment trusts, a way to invest in property without the hassle of owning buildings directly. And alternatives, things like gold or crypto, can add further diversification, but given their volatility or speculative nature, we've only considered them at the margins, if at all. On the next slide. To make informed investment decisions, especially for someone like our client who's looking for both safety and growth, we need to understand the risk-return profile of each investment. That's where statistical analysis becomes essential. Let's start with expected return. This is the average annual return you'd expect from an asset over the long term based on historical data or forecasted trends. Next up is standard deviation, which tells us how volatile or unpredictable those returns are. A high standard deviation means returns fluctuate a lot, which increases uncertainty. Then there is Sharpe ratio, one of the most important tools we use. It shows the return you get per unit of risk taken. So a high Sharpe ratio means you're being well compensated for the level of risk. It's especially useful when comparing different assets. Beta measures an investment's sensitivity to market movements. A beta of 1 means the investment moves in lines with the market. Less than 1 means it's less volatile, while more than 1 means it's more volatile. Lastly, there's correlation coefficient, which helps us understand how 2 assets move in relation to each other. If 2 assets are highly correlated, they tend to move together, which limits diversification benefits. If they're negatively correlated, one goes up when the other goes down, which is exactly what we are wanting to have when building a balanced portfolio for our client. So on to the next slide. Let's start with cash and equivalents. It might not be exciting, but it plays a critical role in portfolio planning. Today, high yield savings account or money market funds are offering around 3 to 4%, which is relatively good given the low risk. The risk is virtually none. It's the safest asset in the portfolio. Liquidity immediate. You can access the cash anytime, anywhere, and it's very easy to access. Downside of it is it doesn't keep up with inflation, so holding too much can reduce real purchasing power over time for our client. So for our client, we recommend 5 to 10% of their cash in cash and equivalents, enough to cover emergencies or short-term needs without dragging down returns. And on to the next slide. Next up is bonds. Bonds are fixed income investments, basically loans to governments or companies. UK gilts are very safe and offer around 4% returns. Corporate bonds return slightly more, about 5 to 6% depending on credit quality. The main value of bonds is stability. When markets fall, bonds often hold steady or even rise. They have lower volatility, typically around 4 to 6%, and they help reduce the portfolio's overall risk. Interest is taxable unless held in an ISA, but they're ideal for income-seeking investors and for balancing more volatile equities. We allocate 25% to bonds in this portfolio for our client. Up next is equities. Equities are essential for growth. Historically, they return 7 to 10% per year over the long term, but they come with significant risk. Volatility can be 15% or more. Dividends and capital gains are taxed, but this can be avoided with an ISA. Why include them desperate risks? Because over long periods, stock outperforms almost every other asset class. They're the engine of wealth creation in a portfolio. To manage risk, we diversify across UK, US and global stocks and use sector exposure like tech, healthcare and some consumer goods. We suggest a 35% allocation to equities for our client's portfolio. And on to the next slide, we have got ETFs/index funds. ETFs, or exchange traded funds, are some of the most efficient tools available to investors today. They track entire indices like the FTSE 100 or S&P 500. They offer instant diversification across dozens or hundreds of companies. Fees are low, typically around 0.1% to 0.3%, and they perform similarly to the market. Volatility is similar to equities, but because ETFs are diversified, they are less risky than individual stocks. ETFs and index funds are perfect for passive investors, and their long-term performances is very strong, especially when reinvested. So we recommend about allocating 20% of the portfolio, our client's portfolio, to the ETFs to take advantage of said benefits. Now on to the next slide, it is on RITS. RITS offer exposure to property markets, residential, commercial or industrial, without buying actual real estate. Average returns for RITS are 6% to 8% with regular dividend income. Volatility is moderate, less than equities, but more than bonds. They provide a hedge against inflation since rents and property values tend to rise over time. Liquidity is not quite as instant as stocks, but still reasonable. RITS also offer a psychological benefit. People like to know they're invested in real assets. We include 10% in RITS to diversify away from traditional markets and add income potential for our client's portfolio. Now on to the next slide. Efficient markets hypothesis. The efficient markets hypothesis, or EMH, underpins much of the portfolio's design. EMH argues that all available information is already reflected in asset prices. This has huge implications. You can't consistently outperform the market through stock picking or timing. Markets are unpredictable in the short term, but trend upwards over time. The most rational strategy is to diversify and invest for the long term. There are three forms. Weak. So for the weak, prices reflect all past prices. For semi-strong, prices reflect all public information. And strong, prices reflect all private information. This is why we use passive strategies like ETFs and avoid speculative or overly active trading. And on the next slide, this is the recommended portfolio we have provided for our client. So based on all the analysis that we have done and the client's needs, understanding the client's needs, here's the recommended portfolio. So we have put 10% of their money in cash and equivalents for liquidity, 25% in bonds for income and stability, 35% in equities for long-term growth for a client, and 20% in ETFs for cost-effective global exposure, and 10% in RITS for property diversification and inflation protection. So this mix gives us a projected return of 6.5 to 7% with manageable volatility. It scores well on the Sharpe ratio, showing strong risk-adjusted performances. Each asset class is chosen for a specific purpose, creating a well-balanced investment plan for our client. On to the next slide. So, tax implication summary. Tax can erode returns, so efficiency in this case very much so matters. ISAs allow £20,000 per year in contributions and are exempt from tax on capital gains and income. Capital gains are taxed after the £3,000 annual allowance. Dividends. Dividends have a £500 tax-free limit. Bond interest is taxed as income, but ISAs and pensions can shelter this too. We strongly recommend maximising ISA contributions first and considering pensions for long-term savings. This ensures our client keeps more of their gains. Now moving on to the conclusion. To wrap up, the portfolio we've built balances liquidity, growth, and risk management. It includes a variety of asset classes with complementary characteristics. It's based on statistical analysis and modern theory like EMH. It's tax aware and designed for long-term passive investing. Most importantly, it's built around the client's real-world needs. A portfolio like this doesn't need constant tweaking. Just a yearly review and rebalancing to stay on track is necessary for a client. So on to the last slide. I just want to thank you all very much for taking the time to listen to this presentation. I hope it's helped you show how we can build a thoughtful, robust investment plan tailored to the client's needs. Thank you very much.